Well, welcome, Jared, to the Mineral Rights Podcast. Thank you so much for joining me today.
Matt, I'm excited to be here. We had you on the podcast, so it's good for you to return the favor. Looking forward to the conversation.
Absolutely. And yeah, I was on the Financial Planning for Oil and Gas podcast, which is his show, and had a great conversation about minerals and royalties and some of the basics there. And that was such an interesting conversation. And I've always wanted to have a conversation with an expert in terms of financial planning and those types of considerations as it relates to minerals and royalties. So I'm excited to have you on, Jared, to share your knowledge with our listeners because, there's certainly a lot of major life events that many mineral and royalty owners can find themselves in. But before we dive into the questions and dive into that conversation, tell us about where you grew up and where did you go to school?
Yeah, it's funny. I actually grew up in Southern California. For anyone connected to Chevron, they'll know the town. It's El Segundo, which was the second refinery town in Southern California. So I grew up right by there. And then going into high school, halfway through high school, I switched. My family moved to Memphis, which I felt like a foreign exchange student going from California to Memphis. Very different culture shock halfway through high school. And so ended up staying close to home and going to the University of Arkansas and studying finance. And so when people ask me where I'm from, it's a tough question because I've spent different time, different places, but grew up in Southern California.
Very interesting. Yeah, I can imagine that's kind of like one coast to the other, very different cultures between the two locations. But I guess it gives you a lot of perspective as you talk to the different clients around the country, which is definitely helpful, I imagine. Now, you're a financial planner. And so, what led you to the world of financial planning, and how did you end up where you are today as the COO of Brownlee Wealth Management?
Yeah, it's funny because, graduating with a degree in finance, I was just kind of shotgunning my resume out to anybody who'd listen. And I ended up getting an interview with a firm that did wealth management for Walmart executives. And it sounded like a really interesting opportunity. The firm owner just bought out his business partner at the time. And so it was an opportunity to really learn small business at the ground level. And it sounded interesting to me. And there was no selling pressure, which was really rare for an opportunity at that time. We could talk more about that. We talk about advisor compensation, but it just felt like a really good opportunity to learn. And I fell in love with financial planning. It's the perfect balance of quantitative numbers analysis, but also, something as important as money, and also kind of like serving as a counselor or a trusted guide to help people really feel empowered to make good decisions. So it was a good balance of relational and math. And so I just kind of fell in love with it and stuck with it. And so my whole professional career has been in, financial advice in various capacities. And so I've been the COO of Brownlee Wealth Management now for 2 years. My partner, Justin Brownlee, started the firm and then brought me on a year later. So I serve in a operations capacity. So trading, compliance, portfolio management, performance reporting, technology, all that stuff.
Very interesting. So, your firm provides financial planning, like you mentioned, and that can mean a lot of different things. I know the scope of financial planning can be pretty broad. So, tell us a little bit about what does a financial planner do? When we go call up a financial planner, is it just to get stock tips, or is it more than that? Can you talk a little bit about what you do within your firm?
Yeah, that's a great question. And it's kind of tough because if you ask five people what they think financial planning is, you'll likely get five different answers. But I would say financial planning is really you help people optimize their life and consider their financial implications. And so what I mean by that is sometimes the life optimal decision is not the financially optimal decision, right? Buying a second home, helping your kids go to college, right? Doesn't really help you in your mission of retirement, but we just kind of help people understand the trade-offs, complexities, and opportunities that come with various financial decision making. But I would say financial planning is comprehensive in nature. Financial planning includes tax planning. How does whatever decision we're making impact my tax situation? How does it impact my estate planning situation? How does it impact my risk management, my asset protection, my insurance, also my investment portfolio? So financial planning is kind of synonymous in, I feel like, with a lot of people for just to mean investment management. Yes, investment management is a piece of the puzzle, but financial planning is when you really take a comprehensive 10,000 foot view and think about how any financial decision affects all of those various categories and how those interact with each other. Because every decision you make has repercussions or consequences across all those dimensions. So it's really considering all of those things and the tax code and your situation and your income and your goals and kind of marries those two together into a plan that best suits you and your family's needs.
And tell us a little bit about your firm specifically and the type of clients that you work with, because I know you have kind of a particular niche within the financial planning industry.
Yeah, so we serve oil and gas professionals. And so what that has come to mean for us is it's a lot of executives and highly compensated employees from super majors and oil and gas service companies. And we also have several clients that own, or majority owners, principally own, or on the executive team of privately held oil and gas businesses. And so our firm is located in Houston. We have employees peppered throughout Texas, and me, I'm in Northwest Arkansas. But primarily, most of our clients are in Houston, and beginning to expand to various other locales where there's oil and gas activity.
Very good. And I know there's definitely some unique considerations for oil and gas professionals. But for our listeners who have minerals and royalties, we want to dive into some of these kind of high level themes and some tips that we can give people about things to be thinking of and when to go get help. Because I think that with financial planning, there's a lot of misconceptions. Like you mentioned, there's a portion of it, and I think a very small portion of it is simply the process of recommending those different types of investments that somebody should be in so that their portfolio is aligned with their goals. But within financial planning and in your experience, what are some of the more overlooked areas that can have a big impact to the bottom line and into those goals that people have?
Yeah, I would say there's a few. I would say getting started too late. Financial planning, there's no secrets, right? It's like it's all about making really good decisions over a really long period of time. And so if you do a few things very well, be conscious about when you recognize income, be conscious about the deductions you're getting, understanding your income, when you plan to retire, your distribution plan, doing all those things well over decades, you make a really material difference. So I think, first of all, one of the things to avoid is just starting off too late. Another thing I would say is having the tax tail wag the dog. And what I mean by that is, we have clients with substantial oil and gas embedded gains, whether that's through interest they own in wells and they depleted and their cost basis is essentially nothing, or oil and gas publicly traded stock. And that asset as a percentage of their net worth is substantial, but they have just really a difficult time diversifying it because of the short term pain of a capital gains tax. And of course, you want to manage that and be prudent with that. But you don't want 90% of your net worth tied up in any one particular asset or one particular industry. So I think really being over allocated to one asset class and then maintaining that allocation because of taxes. And then I think the other thing is, it kind of connects to playing the short term game, is failing to think about lifetime tax rate. One of the big things that we're mindful of in our practice is, you know, what is your effective lifetime tax rate? Because when you're in your peak earning years, it's going to be way higher than it is when you're a retiree. And then before Social Security starts, and before when R&D start, and when you're a young accumulator, right? There's seasonality to your tax rate. And so understanding that and kind of planning around that, accelerating income in low income years, deferring income in high income years, right? A lot of people are hyper fixated on, how do I lower taxes this year? If you're in a low tax bracket, it could make a lot of sense for you to recognize more income this year if it makes sense for your income and tax plan. So, people kind of just getting super excited about, how do I minimize taxes this year, instead of thinking about, okay, what does the season look like from an income tax perspective? And in light of that, are there any strategies to where I can take advantage of the high or low income tax brackets that are presented?
That makes a lot of sense. And, you got to think, I guess, holistically about your particular situation and think long term. And then that helps, I would imagine, guide a lot of those decisions. Now we have certain issues that we face from a financial point of view. What are some of the most common issues that your clients face? And then how do you help those clients address and kind of solve those issues?
Yeah, I would say one of the biggest issues is unnecessary complexity. If you work for a super major or several different super majors and a couple oil and gas service companies along the way, it's really easy to wake up with four different IRAs, three different pensions, two different brokerage accounts with a bunch of different accounts and complexity. And one of the easy things is, how do we manage this and simplify the number of accounts? Do these accounts serve a really intentional specific purpose, or can we simplify? Because we want to simplify if possible. I think the other thing is kind of like, well, this is another point, but not looking at assets holistically. So what I mean by that is, let's say you have a certain investment mix. Let's say it's 70% stocks, 30% bonds. A lot of people would say, okay, in that case, all of my accounts are going to be structured that way: 70% stocks, 30% bonds. But there's different tax consequences to each account, right? Tax deferral, it may be better to put income producing assets like fixed income in the retirement account bucket. It may be more prudent to put higher growing assets in the Roth IRA. So, kind of the same idea, but failing to take a high level view and say, hey, these accounts have different tax benefits and consequences. What type of assets should I put in that account proportionally? A couple other big things that we help clients manage are, like we talked about, embedded capital gains. Hey, how do I work around this? How do I slowly move out of this position without blowing myself up from a tax perspective, but also prudently managing my risk? The other thing is liquidity events. Hey, I'm going to have this event that's materially going to impact my life. And it's a great opportunity, but there's a lot of complexity. There's a lot of ways you can optimize it from an income perspective, from an estate planning and asset protection perspective. And so we see people reach out post transaction. If you have something like that coming down the pipe, it's better to engage a professional early on in that situation. And then for a lot of our clients, they have what we call a tax time bond. So with IRA assets for non-spouse beneficiaries, you have to take the account over 10 years, the full balance of the account. And so if you don't spend down your IRA and you die with a $5 million IRA that your kids inherit, they're looking at $500,000 in income a year or more when you account for interest. So that's another thing that's staring people in the face. There's a law that's changed recently that could have a substantial impact to some of the retirees we help if they're not mindfully managing it.
Oh, that's interesting. And I'd like to dive in a little bit more in depth about those liquidity events as it relates to minerals and royalties. I know there's really two kind of main events that we talk about with minerals, and that's when you sell, and then also potentially when you lease them. If you have a large portfolio of mineral rights, you could be faced with a large influx of income, which is great, but to your point, we need to plan ahead. And after that has happened, that's not the time to start trying to figure out what to do. Obviously, you want to try to make a plan ahead of time. And so I'd like to dive into that. But before we go and switch gears into the minerals and royalties side of things, one of the things I've always been sort of hesitant to engage the services of a financial planner is just, the question in my mind has always been, how do I find one that is looking out for my best interests? I always kind of feel like, well, it's maybe some of the people I've talked to in the past, it's the advice I'm getting is based on they're putting me in something that is going to give them the highest commission, and they're trading a bunch. And, is that really acting in the best interest of the client? So, in terms of finding a financial, is it just a matter of interviewing somebody that you think you can trust and then deciding to go with that person? Or is there a particular designation that somebody should be aware of and look for that helps ensure that the person that they're relying on is looking out for their best interest?
It's a great question, and one that I feel like Wall Street has made intentionally confusing because they have an economic incentive to do so. So I think a good place to start is there are a few questions you should ask to help orient you in the right way. I think it's how are you compensated? And at the 10,000-foot level, there is what's called fee only advice. So the only compensation the advisor receives is from the client. There's hybrid advice or what's called duly registered firms where they can receive commissions from selling products to clients and compensation from the client. And then there's a commission only relationship where the only exchange of cash is from the business to the advisor. And so the reason why that's important is those different transactions have different legal standing. So if you are in an advice dispensing capacity, you are required to act in a fiduciary standard. So putting the intentions of the client, you got to put their efforts first. You got to advocate for them legally. You're bound to act in their best interest. For dispensing investment products, you are held to a suitability standard. So you're not legally required to act in their best interest. You just have to prove that the investment was in fact suitable. And so a good way to think about this is what's at the center of the relationship. So understanding how is the advisor compensated? Is it by you, which means you're on the side of the table, or is the business compensating them where they have incentives to place various product on their shelves? And the way that they get paid by the business is you. But at the end of the day, they don't really answer to you. They answer to the firm that's selling the products. And I guess another good question is about how they're compensated, but about how to find a firm that's a good fit for you is I would ask also, do you work with people like me, and what will you help me with? Like us, we built our firm specifically for oil and gas professionals, and that's who we serve. If somebody says, "Hey, I work with doctors, I work with business owners, I work with widows, I work with retirees," I would run from that advisor because they pretty much told you that, "Hey, I'm a generalist." And different people have different situations, so I would find somebody that specializes in working with what you're working with. And the other question I would ask is, what will you advise on? So if you think about even a fee only advisor, they primarily manage a portfolio and charge an assets under management fee. But the problem is if you own oil and gas or mineral interests or private investments, the advisor might not have an economic incentive to advise on those assets. And so some may not, but it's something you want, hey, I know you're going to manage a portion of my portfolio or charge a retainer to provide investment advice. What do you advise on? Because a lot of people will just, hey, I'm just going to advise you on the portfolio and I'm going to ignore everything else, which we don't think is financial planning because you got to consider the whole picture to make really good decisions. So also understanding how are you compensated? What are you going to provide advice on? And do you work with people like me? I think are three really good questions to begin to get in the right way of, hey, is this an advisor a good fit for me?
Oh, that's some great advice. And in terms of getting into that kind of fee only structure, I've heard of the term registered investment advisor, RIA. And I believe you guys are registered investment advisors. Is that correct?
Yes, registered investment advisory firm, which basically means we're structured to get compensated for giving investment advice. And I think that's part of financial planning is such a new profession. You asked about this, Matt, and we didn't touch on it, but gold standard designation is the CFP, Certified Financial Planner. I'm a certified financial planner. My business partner, Justin, is as well. I would say the regulatory threshold for becoming an advisor is really low. So I would definitely look for somebody that's gone kind of above and beyond just the questions about the Investment Act of 1940. But yeah, so we are licensed to give investment advice, which is kind of why people think investments and financial planning. They're related, but they're not necessarily the same thing. And there's also a broker dealer, so a firm that's registered to sell investment products or insurance policies that have various commissions and trails and things of that nature.
Good. Yeah, it's important to understand those different designations because, like you said, there's a lot of nuance there. So, no, thanks for breaking that down for us. That was very helpful. Now, let's switch gears and talk about minerals and royalties, which is really the main interest for our listeners. And I've received those questions similar to what you're referring to, where somebody's had a major life event, major liquidity event in terms of receiving an unexpected sum of money. And the question I usually get is, hey, is there some tax loophole that I can take advantage of so I don't have to pay taxes on all this? I got $300,000 check. What do I do? And I'm like, well, first of all, I'm not an accountant. I'm not your CPA. So you need to contact your CPA to get tax advice. But unfortunately, I'm not aware of any major tax loopholes that relate to oil and gas interests. So you're probably going to have to pay the taxes on that. But, in terms of planning ahead and thinking proactively, which is kind of what I always like to talk about, it's pretty easy. If we're going to sell, usually there's some notion that we're going to divest this interest and reinvest that into something else. And maybe it's a discussion with your financial planner that they say, hey, you have a lot of your portfolio in oil and gas interests. Maybe you should think about diversifying. And if you make a decision to sell, then that's the time when you need to be talking about, okay, now how do I minimize my tax liability or think big picture timing wise to your earlier point. And so I know everybody's situation is different, but what are some high level tips you can give for folks to think about if they find themselves in the situation of what are some of those considerations? And then what should people do proactively if they think they're going to find themselves in that situation?
Yeah, I would engage with a professional early, but realistically, Matt, you're very aware of this, but you could do a 1031 exchange, right? You could change it into like property to kind of further delay that capital gain. But another thing I would just think about philosophically is make sure everything in your personal life you're considering deferring income, right? If you know you're going to have a big windfall, you should be maxing out your 401k. You should be contributing to your IRA if eligible. If you could do HSA, you should also be maxing that out. If you're self-employed and there's self-employed plans or a cash balance pension plan, right? So you're going to be in a very high tax bracket. You have a very lumpy year from an income tax perspective. How can you defer some of that? And it's a great time to fully load up those accounts if you're not already fully funding them. Another interesting opportunity is if you're philanthropic, consider bunching charitable deductions. So with the standard deduction being as high as it is, most people don't have enough to itemize their deduction. They generally take the standard deduction. But if you're going to give, let's say, $5,000 a year over the next 10 years, instead of doing that, just do a $50,000 gift to a donor advised fund the year that you have that big liquidity event. And if you wanted a 2.0 that, you could gift some of the interest to the donor advised fund before the transaction takes place. So you wouldn't even pay capital gains on the portion of that amount that's gifted. So I would say be proactive, start planning before. But one of the big things is, okay, there's other than 1031 exchanges and the qualified savings accounts, there's not a ton that you could do to make taxes just evaporate. Of course, this isn't legal or tax advice, but just philosophically, there's not a ton you could do. But it is, hey, are my account, am I fully taking advantage of the tax advantages available to me? And if I am doing things that create a big itemized deduction, can I lump those into a big year so I can get a big itemized deduction versus taking the standard over several years? Because I have this windfall and have extra liquidity to kind of fund some tax deductible gifts.
That's good advice. And so, what I'm hearing from you is really need to plan ahead and be reaching out to your advisors in advance of that type of situation. And I would say that's easily done if you're thinking about selling because they can help you make sure the timing is right. I think to your earlier point is in my lifetime, what does my income tax look like versus if I'm having to pay long term capital gains? And, maybe it does make sense to sell a portion of your interest and pay that long-term capital gains in terms of the overall tax bill being lower, maybe it's going to be a one-time hit, but over the life of those wells, it could be a lot less in taxes you end up paying. So I think those are the types of conversations that your financial planner can help advise you on. And the other thing is a situation where somebody inherits mineral rights and they just really don't know what they're worth or how does that fit into the picture. And if you think about that situation, one way you could get your financial house in order potentially would be get an appraisal to understand what those interests are worth. And then that could help you decide whether or not you should sell a portion of it or keep it, or how does that fit into the overall picture. Now, as far as after the sale, so we've talked about best practices prior to the sale to optimize our tax situation. Once you have that money, so let's say you have this lump sum of money that you're now, okay, what do I invest in or what do I do with this? Are there things that people should be thinking about as it relates to how that fits into their goals? And what are some of the considerations or tips that you would give people in those situations?
Yeah, I think this one's kind of blocking and tackling, but you'd be surprised how often it's not considered. But I would say run tax projections is really important. A lot of times with these windfalls, there are no taxes withheld. So you get this big check, but there's also going to be a tax liability. And it could be substantial if you have other forms of income. So getting with an advisor or a CPA to run a tax projection to see, okay, how much of this, after all the strategies I'm going to implement to kind of manage this tax liability, how much of this is already spoken for? Because the last thing you want to see is somebody allocate that full amount to something else and essentially realize, hey, I'm not liquid enough to kind of manage the capital gains tax. And so I think that's another interesting thing. One thing, I don't know how often you see this, but one thing we see with other types of transactions, not necessarily minerals, but I'd be curious to hear what you think. Installment sales are really interesting because if you could spread payments out over a couple of years, I think that's advantageous to kind of managing the cap gains tax brackets. In this country, there's actually a 0% capital gains tax bracket. And so if you execute on this transaction when you're retired, there's a chance you could have a portion of the gain subject to no tax liability. But I think really kind of understanding, okay, what exactly are my capital gains tax consequences? Okay, what are the tax projections? And then, okay, what are my goals, right? How do I feel about my balance sheet? Do I own enough in oil and gas interests? Do I want to diversify? How well positioned am I for retirement? I think it's a great place to start with, okay, what is my goal and how well suited am I to serve this goal before I make a big allocation decision? But generally, I think it's good to kind of philosophically decide that before the liquidity events happens, because a lot of times the liquidity event will happen, and then you'll meet with the client in anticipation of the liquidity event, and then next year, and a lot of it's been spoken for just in lifestyle inflation. So I think having a conversation, sitting down pre those funds landing in your bank account, it's a good idea. And we haven't really touched much on this, but for people with substantial liquidity events, there's another question of, okay, who is best to get these interests? Because if you have a taxable estate, or estate taxes are a potential concern for your family if you have substantial assets, it might not make sense for you to be the one to get that whole check. Maybe you set up a family limited partnership and gift limited interest, so you still retain control, but some of those windfalls go to future potential heirs. So there's really kind of a bunch of nuance, but at a high level, it's understanding, okay, what are the consequences? Do I have enough cash to set aside? And then really, what are my goals? And I think if you do a good job answering those three questions, you have a good idea. Okay, what do I have left over, and how do I want to invest it? The average advisor would tell you just, hey, throw it in a stock portfolio, but that's just one of many ways to allocate it, and it's a super personal decision.
It makes sense that it's a very personal decision and each person's different and different goals. So you got to take that into consideration. But I like how you brought up the installment sale concept. And that's the equivalent of that in the minerals and royalty space is maybe only selling a portion of your interest and you can spread it out over time. If you want to eventually divest that particular asset, you don't have to sell it all at once. You could sell 20%, you could sell 50% or whatever percentage you want. And I think that's again where having that conversation with your financial planner to talk about, okay, how much income should I realize from this sale? How does that fit into my overall plan? And then should I spread this out over time, just to your point, to try to optimize the tax situation? And so I think that's another consideration. If somebody is thinking about selling, it's okay, do I need to sell it all? Do I want to sell a portion of it? So that's definitely something to think about too.
And Matt, one other thing I
So
would add is if the primary owner of the minerals is older, there's a step up in cost basis opportunity, right? So, with depletion, your cost basis gets eroded over time. So most people with oil and gas interests that they've been sitting on or mineral interests that they've been sitting on for a while usually have a really low basis, really large embedded gain. But a portion of that gain, depending on how much is owned by, the deceased person, would get a step up in basis. And so, if you're in a spot where a lot of those interests are owned by somebody that's older in years or has deteriorating health, that should definitely be part of the equation as well.
Yeah, and I think if you're set to inherit those, that's where you have those types of conversations. Hopefully, have an open conversation about what your parent or your relative wants to do. What's their goal with that asset? Is it what they want to keep that in the family? But I think to your point, that step up in cost basis is a huge opportunity, especially now with the shale revolution and the value of these assets. I would say over the last 10 years, having appreciated materially because we are drilling these long horizontal wells. The wells are very productive, royalty payments are high. And so as a result, the value today is a lot higher than it would have been maybe 20, 30 years ago when you inherited them or when a relative inherited them. When they were just drilling vertical wells, it was hit or miss whether they would find oil or gas. And maybe it's in the middle of a hot oil and gas basin. That's a time where passing these down to your heirs might make a lot of financial sense for your family when you think about the bigger picture and wanting to maximize what your heirs are going to take home at the end of the day. And, handing it down to them might actually be the best way to go about it. But the other thing, if you're in that boat, we always talk about minimizing the fractionalization of these assets. If we hand it down, you have 10 grandkids and you're going to each give them 1/10, that's going to dilute the value of that interest over time as they pass it down to their kids and so on and so forth. So think about maybe holding it in a certain type of entity, a family LLC or something like that, or holding it in a trust and then naming beneficiaries. And then that's the way that you could keep it whole so that the value is retained, but then allow your heirs to benefit from that. But there's a lot of tax considerations associated with passing down these types of assets. We could talk about that in an entire episode. So let's shift gears a little bit to the ongoing management of minerals and royalties and how that fits into someone's overall financial plan. And when you think about mineral and royalties, and a lot of your clients probably own some oil and gas interests as well, what are some of those financial planning considerations when you're thinking about having that holistic view of their portfolio and their net worth and diversification of assets? Is there some things to think about as they, think about their risk tolerance and all of that? I know it's very person specific, but how do these assets fit into someone's overall financial plan? And at what point does it become too much and do they need to think about maybe diversifying?
That's a good question. So, I mean, philosophically, like if you think about like running a retirement projections, you're thinking about how does this impact my future? I would think about what is your intended use. A lot of these assets that we see the clients have are kind of legacy assets, and it's a lease that's been in the family for a really long period of time, or they own the underlying land, and they just kind of want to retain it indefinitely. And so, in that sense, I would kind of include it as an income source when you're thinking about it from a planning perspective. I would also, if you're running projections, I would just kind of provide a conservative estimate, right? Because commodity prices fluctuate, the value of the asset may fluctuate. So I would kind of, from a conservative perspective, maybe dial back the expected income if you're projecting what's the net present value of this asset, or can this plus Social Security and pension, can I afford to retire? And kind of like you're saying, it's really personal, but I would say what is your risk tolerance? So, these assets are great, but they're also way less liquid. And so if you don't have sufficient liquidity, especially if you're in the decumulation phase of your portfolio, these interests might produce enough for living expenses. But if you want to buy a car or a second home and everything's tied up in these assets, it might be tough to kind of create the liquidity to fund these one-off expenses. So just kind of making sure that you're liquid and also that you have the stomach for it. I would say generally the higher your net worth is, the higher the percentage of you can have in illiquid assets that are more specialized target exposure. And I would also say it depends on the family because, do you own one type of mineral? Do you own mineral interests in several leases in one basin, basins all across the US? And so really understanding, okay, like how diversified, even my mineral interest portfolio, how diversified is that? And am I comfortable with that amount of risk, right? Over the next, 20, 30 years, legislative risk becomes a material part of the equation, right? You might own substantial assets diversified across minerals in one geography that passes legislation that makes them essentially worthless or worth fractions of what they were overnight. So I would definitely say there's higher risk. And because of the higher risk, there's often that's higher opportunity, but it's all kind of a function of what is your risk tolerance? What does your other portfolio look like? And how much pressure is there on these assets to perform? Because, for a lot of our people, they have a pension and qualified funds that'll produce more than enough for their living expenses. And they have some oil and gas interests, and they're happy to kind of let it ride, let it potentially fluctuate and just kind of hold on to them indefinitely. But if you're getting 100% of your retirement paycheck from mineral interests, then maybe time to kind of diversify your income streams a little bit. But it's definitely personal. But hopefully, those philosophical ideas help people kind of understand where they might fall in the spectrum and how much urgency there should be uh, to diversify or consider alternative investment sources.
Thank you for that. That's helpful just to think about some of those high level philosophical questions that we can all ask ourselves and sort of think about, how do I feel about this? Is this headed in the right direction, or am I uncomfortable with my asset allocation? And, am I totally weighted on oil and gas and I'm worried that prices are going to fall and I need that income? Then that's a conversation that definitely is worth having with your financial planner, like you mentioned. So, thinking about estate planning a little bit, another aspect of financial planning is thinking about what our goals are in leaving a legacy to our heirs potentially. And so when we're thinking about handing these types of assets down to the next generation, or just thinking about that in general, what are you thinking about as far as estate taxes? And I know it's hard to read the tea leaves, but where do you see that going in the future? I know there's some worry that the estate tax limit's going to be significantly lower, so that would expose more people to paying estate taxes. What are some of the financial planning considerations if you are in a high income situation to minimize the future tax liability for your heirs?
Yeah, I'm not a market prognosticator, but I will say the estate exemption is abnormally high by historical standards. And if you think about political energy, it's pretty bipartisan to sell the idea of taxing people with estates. And so, in light of that, I definitely see it being easy to sell lowering the estate tax exemption to more historical levels or even lower than historical levels. And so, that being said, there's what's called the annual gift exclusion. So, you can gift assets to beneficiaries up to a certain amount. It's a non-reportable event. And so if you are in the position and that's the other thing, you might not be in an estate taxable position today, but if you do compounding and think about you 30 years from now, if you're underspending your assets, you can get there. Right. And so don't just hear the estate exemption numbers, which is 24 million today, and think, oh, I'm never going to get there. There's no way. One, the exemption amount can change, and two, your assets could grow if you're not depleting your portfolio. And so there's a lot of things you could do from that perspective, especially with annual gift exclusions and taking advantage of that. I would also add, Matt, there's like a non-financial consideration that you kind of touched on a little bit of. It's like, hey, I want to optimize taxes, but I also don't want to create a mess. So, one of the things we really like about FLPs is you can gift limited partner interest. So you could gift, basically interest in future income, but none of the decision making interest. Because, like you alluded to, Matt, if there's multiple generations involved and they all just own identical voting interest and profit interest, it could become a really convoluted mess to make any decision related to that. And another consideration is, hey, what's the future income tax for my kids? Them taking advantage of this income today, are they at a better tax rate than I'm in? So there's really a lot of ways you could play it. But like everything else in financial planning, being proactive and being aware of what could potentially happen from an estate tax perspective, and making decisions today to make annual gifts if you're in that position, and determining, okay, what assets to gift. Because there's various pros and cons there. Because if you gift the asset, they inherit your cost basis, but it could be advantageous depending on what valuation you give. But from an estate planning perspective, if you think you may be in the universe, the time to start planning is today.
That's helpful advice. I agree with your thought processes. It's, historically high. It's probably going to come down, especially as the government is facing budget shortfalls and worried about spending and things like that. They're going to look at how do we bring in more income. And from both parties' perspective, they seem to go after the higher income earners, higher tax bracket folks, saying, well, it's okay if we take it from them and give it to the poor, the Robin Hood kind of effect. But switching gears a little bit to talk about your podcast, because I've been listening to your show and been really enjoying some of the episodes. You had one recently on risk management, which was really helpful. Can you talk a little bit about your financial planning for oil and gas professionals podcast? And I can imagine that pretty much anybody can benefit from that, not just oil and gas professionals. I know I certainly have benefited from listening to that. And so I recommend everybody check it out. But why did you guys decide to start the podcast?
Yeah, so FPOG, as we like to call it, financial planning for oil and gas professionals, it was really just birthed out of a desire to educate. We want to lead with education. Our firm is young. We're 4 years old. We're all under 40, so we're young. And the historical advisor looks older, a little grayer hair, a little more experience. And so we want to lead with education and prove, hey, we can help, we can add value. And really just kind of double down on who we serve and how we serve them. And it was just kind of a great forum because we were getting great questions from clients and prospects at meetings and say, hey, what if we took this to a wider audience and answered this on a broader stage? And so it's been a great from a business development perspective, but also helping us kind of understand what episodes we should do, what different topics we should talk about. It's really helped us kind of refine, hey, who are we best suited to serve and what's really top of mind? And then kind of having these higher level conversations like you and I are having to kind of point somebody in the right direction. And if they want to do it themselves, great. But if they decide they need the help of a professional like you or me, they know where to find us.
Very good. So now, what are some of your favorite episodes that you've had so far? I think you're almost 60 episodes in so far.
Yeah, we're almost 60 episodes in. And man, of course, one of my favorites is when we had you on the podcast to talk mineral rights. But a lot of that was probably 101 because our audience skews more financial planning. So probably a little elementary for your audience. But I think some of my favorites, we kind of talked about this in the podcast a little bit today. Episode 44, we really talk about what is financial planning. It kind of just gets into philosophical, hey, what is that conversation like? Another episode that was really kind of interesting and fun to make, it was more Justin and I riffing on an idea we've had working with these people, is why we think oil and gas makes better investors. One of the things, we've both worked at a bunch of different firms. And so one of the things we've observed is that oil and gas investors, they have like iron stomachs, like market volatility doesn't impact them the same way it does other investors from different parts of the market. So we just kind of unpack that idea and why we think that's the case. So those two are kind of two that really stick out that I think your audience may enjoy.
Cool. Yeah, definitely go check it out. And where can people go to find the shows and those episodes?
Yeah. So brownleewealthmanagement.com. And Matt, I can send you these if you want to link to the show notes. FPOGpodcast.com. We're on anywhere you listen to podcasts. We're also on YouTube as well. But brownleewealthmanagement.com will be the great place to find them.
Very good. And then, is there anything else that you'd like to mention before we wrap up?
No, that's it. That's it. And you said a lot of the same things on our podcast, but the best time to start is today, right? In anticipation of things. So often we get in front of people after the fact when we look under the hood and maybe, man, had we gotten in front of you 3, 4, 5 years earlier, we could have saved you substantial money from a tax investment expense perspective. And I'm sure you probably feel similarly from the mineral rights perspective. It's one of those things where it's really important, but it's not necessarily urgent. It's so easy to just proverbially kick the can down the road. But it's one of those things where, if you make it a priority and you find somebody you really like and trust, it can have a really outsized impact on you.
No, that's excellent advice. Yeah, and to your point, I do get those calls saying, "Hey, we've sold our minerals. Now we need an appraisal to hopefully claim a step up in cost basis." And it's usually the end of the year. People are rushing, trying to get their tax planning done. And so, certainly, to Jared's point, you want to be proactive and reach out to your financial planner if you need an appraisal. If you sold your minerals, working with your financial planner, get with a consultant or an appraiser to get that done so that your financial advisor can best advise you and how that tax situation needs to be handled. So that's always something to think about. I think that kind of theme of being proactive is important in financial planning too. We think about minerals and royalties and certain life events. We always talk about that. And understanding what you own is always an important first step so that you can then have those conversations and have those discussions about how those assets fit into your overall financial plan. And if you don't understand what you own, then you can't really have that conversation. So I think that's another thing to think about is, do I know all of those assets that my great uncle that was in the oil and gas industry owned, and did I have a full accounting and a full inventory of those? Or is there something else out there that I need to maybe do some research and try to figure out? Do I actually maybe have an interest in some other minerals that just hasn't reared its ugly head, so to speak, because a landman hasn't contacted me yet? So thinking about overall, how do I look at these assets? How do they fit into the bigger picture? Reaching out to somebody if you need help. And on that note, we'll link to the Brownlee Wealth Management website in the show notes. So definitely go check that out. And then, Jared, are there other ways that people can get a hold of you if they have questions or if they're interested in working with Brownlee?
Yeah, I would send a message to podcast at brownleewealthmanagement.com or hello at brownleewealthmanagement.com. You can anonymously send us ideas for future episodes, or if you have questions about your specific situation, happy to have a conversation.
Very good. We'll link to those email addresses in the show notes. Also, highly recommend checking out the Brownlee Wealth Management website. Their blog is a wealth of information and talks about a lot of these concepts in more detail. So, if financial planning is a black box and is a mysterious thing that you really want to learn more about, they do a great job of educating their clients and educating the public in general about financial planning and demystifying it. So, thanks again for your time, Jared. This was a very useful conversation. I think our listeners will get a lot out of it.
Awesome. Thanks for having me, Matt. Really enjoyed it.